Bodke, the CEO and Chief Portfolio Manager at Prabhudas Laldar, is now joining us. Hi Ajay, always a pleasure chatting with you. So if I look at your recent reports, you are talking about FMCG companies looking for double-digit growth. The DRIs are receiving inflows via SIPs, etc. So can you share with us why it is that you like FMCG space? We've seen the earnings come back, but then every fund manager is talking about FMCG. Isn't this going to get to be a very expensive space?
Yeah. Good afternoon. I think if you look at the numbers announced by consumer-focused franchises, and this is true not only for FMCG companies, but also quick service restaurants, where we have seen very strong same-store sales growth, or in case of auto and auto ancillary franchises, or retail-focused private banks, as well as NBFCs. I think a common thread underlying the performance of these consumer-focused franchises is strong growth that one has seen. In case of FMCG companies, very strong double-digit volume growth, where rural growth has been a few percentage points higher than the urban growth. And this is a second quarter on a trot that one is seeing sustenance of these double-digit volume growth numbers. What is also heartening to see is that the pricing power has come back, accompanying this double-digit volume growth, leading to very strong sustained growth in EBITDA levels for these companies. In certain cases like Britannia, in fact, one has seen a gross margin improvement on a quarter-on-quarter basis. So the companies, I think, have been able to sustain strong margins, and with operating leverage coming into play, one is seeing a very strong bottom line growth for these companies. I do take your point that the valuations in certain franchises does appear to be forbidding, and that's why I think some of these stocks possibly could see some time correction. However, as long as the underlying earnings growth remains between say 25 and 35% growth, with the strong working capital management displayed by these companies, many of them are operating on negative working capitals like levers, so we are very positive on these franchises. If the monsoon pans out to be near normal, then I think the growth impulses on the consumption side will get strengthened post-harvest at the time of around Dussehra Diwali. And the second half of this year, we are penciling in stronger growth for these consumer-focused franchises. So our allocation remains heavily focused on these franchises that I just mentioned: FMCG, retail companies, auto ancillaries, and retail-focused consumer franchises.
Okay, so good to know that. And Ajay, now I want to talk to you about the auto pack. It's in focus today, not just because the government's important clarification on axle load norms, which is certainly going to impact Ashok Leyland, for example, as well as CV makers like Tata Motors, but you're seeing two big earnings today: M&M, which has come out with its earnings, as has Motherson Sumi. How are you approaching the auto pack at the moment?
Yeah. See, broadly on the auto pack, we are positive on the farm equipment as well as the passenger vehicle subsectors. I think we are not very constructive as of now on the two-wheeler companies. Hence, our allocation is focused on on passenger vehicle companies like Maruti. This quarter has been slightly tepid insofar as the performance is concerned, but with the rural growth, I think, coming back roaringly, especially in second half, I think we are expecting Maruti to be the prime beneficiary of this improvement in the rural demand, as well as the urban demand also is holding up quite well. On the number, M&M, I think, has posted stellar numbers. I think margins are at multi-quarter high, and the company has performed better both on the top line and the bottom line front. The key for continued outperformance of M&M clearly, in my opinion, lies with some of the new launches that have been lined up for the next 6 to 9 months on the passenger vehicle side, and that is the division that needs now to join the party Till now, I think the performance of the farm equipment business has been stellar. The company has been leading from the front, gaining market share, and having posting very strong margins. So I think the market, in my opinion, will digest the sharp up move that one has seen in the stock from 750 odd levels to the current levels, and only after seeing the response that the market reposes in some of the new launches on the PV side, a further re-rating of the company, in my opinion, is likely to happen. Mahindra and we are positive on Maruti. Also one contrarian play, if one is willing to take 18 to 24 month bet, is Tata Motors. I think all the negatives that had to hit them on the JLR side, various headwinds in various geographies has hit them. But I think now with China business should come back with the drop in import margins from 25 to 10%, and one should look at Tata Motors with a medium-term perspective.
That's certainly a contra bet after the quarterly performance of Tata Motors, the auto sales figures, what's happening in China, the very expensive Brexit that is also keeping Tata Motors in the slow lane. Ajay, always a pleasure chatting with you. Thank you so much for joining us here on ET Now with your views. So we were just talking about Motherson Sumi and M&M with Ajay. The two counters did come out with their earnings.